Let me start with the origins of the problem. This first chart presents some data on changes in the types of mortgages that individuals held in the United States. And you see here on the chart that after 2000, there were an increasing number of home buyers that were using more than one mortgage to finance their home. This is sometimes referred to as piggyback mortgages, where you have a first mortgage and a second mortgage and basically don't put any money down at all for the house. Mortgages where all you pay is the interest, you don't pay anything towards the equity in the house, or even mortgages where payments don't cover the interest payment due. So as time goes by, you don't pay off the equity and you accumulate more interest charges. Now, all of these types of mortgages can, quote unquote, work for you as long as your home price is rising, because then the equity in your house is increasing, but not because you've been paying for it, it's because the house price has been rising. This is kind of, it's like a Ponzi scheme that works pretty well as long as the home prices keep going up. So what happened to home prices in the United States? Well, in the 10 largest cities in the United States, we saw, starting at the end of the 1990s, home prices rising pretty rapidly. And for the nation as a whole, prices start rising as well in the first half of this decade. Prices for homes peak in the large metropolitan areas in 2005 and start to follow, and the nation as a whole follows this downward trend in home prices in April of 2006. So what's the problem? With the housing boom and rising house prices, more subprime loans were made to people who were increasingly less qualified to borrow. The minute home prices declined, people struggled to meet their payments on homes that were now worth less than they had bought them for. This resulted in higher foreclosures, especially when people got to a point where they had negative equity in the house, i.e. they owed much more on the house than what they could sell it for. So it was easier just to give the keys of the house to the bank. Only they didn't even know who to give the keys to, because the loan had been securitized and put out in the market, and actually what they had to do was to cut up the keys into different pieces because so many different people had the loan. So with higher foreclosure rates, home prices fell, and now we're into a vicious circle. So let me finish up with what next, or what keeps me awake at night. First thing that keeps me awake at night, I worry about the next shoe to drop. And here I think there's 3 potential shoes to drop. And this is not the next financial institution that's going to go under. These are slightly different issues. First shoe that could drop is what happens in the labor market. As I've said, the best predictor of foreclosures is losing a job. So if job losses continue and accelerate forward, more people lose their homes, house prices will continue to fall. As house prices continue to fall, these assets, these mortgage-backed assets, become less and less valuable, more companies become insolvent, and we're stuck in this financial crisis. So whatever we can do to keep job losses at a minimum, I would say should be a big part of the package that we're talking about right now. Second thing, exports have been a real savior for us. Actually, productivity of workers as well, but exports has been a real savior for us. But as Europe and parts of Asia weaken, they don't buy our goods, and the U.S. economy slows down. And as it slows down, people lose their jobs, foreclosures go up, and home prices follow. You kind of hear the song now at this stage. Third problem, businesses have been relatively profitable for the last decade, and they've been able to use these profits for investments. But we've seen, especially over the last week, commercial paper basically has disappeared. So if businesses need to go out and borrow, they can't issue debt. Banks aren't going to lend to them because they're hoarding capital, because they're terrified of what's sitting on their balance sheet. And so if firms can't invest, then that again will slow down the economy. Longer term, I think that we really need to engage in a much more significant and serious discussion about our social contract in this country and the role of unfettered markets versus markets with rigorous regulatory oversight. How do the gains and the blame get shared in our economy? And whatever regulatory reforms we put in place, and they are coming, it's a real challenge to put in place regulatory reforms with a nation-based strategy when capital markets are global. And
Well, if you didn't like what Mom had to say, you might be downright depressed when Dad talks a little bit about the outlook for the U.S. financial system, the U.S. economy, and the world economy. So let me start by, if you will, quickly reviewing some of the points that Lisa raised within the global context. This is the first global financial crisis that began in the United States. When I was the chief international economist at Bank of America, we always took the perspective, oh, it's a Latin American problem, it's an Asian problem, it's a Russian problem. Thank goodness we in the United States have great banking system, great regulators, and a strong economy. Well, guess what? This time it started with us, and it started with the home market, and it was exacerbated by lax supervision and lax regulation. And essentially, we can think about the problem as a bursting of the U.S. housing market. And as Lisa said, prices dropped, companies lost billions, firms cut back on lending, pop goes the bubble, and what comes next? And the problem, of course, was made worse by the animalistic tendencies on Wall Street during a financial crisis. And essentially, the hyenas pick off the weakest first. We have the insurance companies, we have the U.S. banks, they gorge on their prey, and they continue. And they continue until they're stopped. And when they're stopped by the U.S. government, what does that mean? Well, it means two things. Somebody's going to have to pick up the bill, and you can see where the finger's pointed. Who pays when the U.S. government intervenes? And what's called moral hazard. The government started to step in and rescue, if you will, the system. But did they do it on a systematic basis, on a thoughtful basis? Let's catch our breath and think about what's happening? No, it was ad hoc. And what they really didn't think about was that we had created a house of cards of our U.S. financial system. And for sale bubbles based upon credit cards. That was the U.S. financial system, which meant it was going to be vulnerable to a financial tsunami. Greed, fear, and uncertainty created the perfect storm. So again, let's go back. House of cards, financial tsunami. Guess what? We all got flattened. Can a weaker United States lead? And regardless who our president's going to be, a new president and what I would call a wake-up call for the West. It's going to be hard to lead by the big stick alone. Diplomacy may make a comeback. Can the United States compete? Is there a way out? And indeed, there is a way out. And over its history, the United States has always risen to the occasion through innovation. So what are the keys to the U.S. economic future? First, we're going to have to find some way to increase our investment in education. We're going to have to rebuild our aging infrastructure, whether it's the privatization of roads and power plants and utility companies, or it's the government putting more money in. We're going to have to increase investments in clean energy and life sciences. And let me stop for a minute. I was thinking about this. At the business school, if a student said, I have a business plan, I'm running a country, and here's my premise for growth and economic supremacy. I'm going to import fossil fuels from hostile nations that pollute the environment, weaken the economy, and strengthen the economy of our enemies. It's not an A paper. So clearly, it seems to me that whoever wins is going to have to come up with a national energy imperative. We need to reduce our dependence on polluting imported fuel, and it's not a matter of can we afford it, but we must do it. But there's another part, and I call it regaining our moral compass as a nation. The United States was always known around the world for its democratic principles, for the concepts of promoting democracy. We need to regain that moral compass.